Disclaimer.
Listen closely. If you're planning to buy even a single ounce of silver in February, stop right now. JP Morgan has just set the most expensive trap of the decade. And if you hit that buy button before you see this chart, you're going to become their exit liquidity. We just watched silver rocket to $121 and crash to $85 in a single week. Everyone is calling it a collapse. I'm calling it a scam. While you're staring at the red on your screen, JPM is issuing delivery notices for millions of ounces, using the new 9% margin rule to flush you out of the market. But before I show you the forensics that prove this was engineered, you need to understand exactly what happened in January, minute by minute, because what looks like chaos was actually a perfectly executed playbook that Wall Street has run twice before in our lifetimes. On January 29th, 2026, silver touched $121.64 per ounce for the first time in human history. 36 hours later, it crashed 31% in the single worst collapse since 1980. If you were trading silver that week, you just lived through something that happens once every 45 years. And the story Wall Street is telling you and the story the data tells are two completely different things. Let me take you back to January 1st, when this all started. Most Americans were nursing New Year's hangovers, but across the Pacific, China made a move that changed everything. The Chinese government officially designated silver a strategic material and restricted exports through mandatory licensing. According to China's export policy announcements, only 44 qualified companies could now ship silver out of the country. Think about what that means. China controls roughly 13% of global silver mining, but here's the part that should grab your attention. They control 60 to 70% of the world's refining capacity. Within days, our markets started showing something unusual. The Shanghai silver premium over London benchmarks, which typically runs 50 cents to $1 per ounce, suddenly widened to $5, then $8 by mid-January, according to London Bullion Market Association data. You might think that's just normal market volatility, but traders noticed something else. Exchange for physical spreads, the mechanism that keeps prices aligned between different markets, expanded from their historic 25-cent average to over $1.10 per ounce. What does that actually mean? It means silver couldn't physically flow between markets fast enough. Even when price differences screamed for arbitrage, the infrastructure was breaking down. But here's where January gets interesting. For the first 3 weeks, fundamentals seemed to matter. Silver climbed steadily from the mid-70s toward $90. Investors who understood the China supply shock were making calculated bets. The metal was expensive, sure, but the logic made sense. Then January 21st arrived and everything changed. Logic stopped mattering. Emotion took over. Greed replaced analysis. Silver broke $100 per ounce on January 23rd. Pop quiz, what do you think happened next? If you've studied market psychology, you know exactly what happened. The breakout triggered every dormant algorithm, every retail trader watching from the sidelines, every financial media personality who'd ignored silver for years. They all piled in at once, creating a feedback loop that sent prices vertical. January 27th brought the gasoline. President Trump told reporters explicitly that the dollar's decline was great for American exports. Those exact words, confirmed in news reports, sent the dollar index plunging to 95.566. The next day, January 28th, the Federal Reserve held rates steady at 3.5 to 3.75%, with Chairman Powell leaving the door open for future cuts in the FOMC statement. For silver bulls, this was the perfect storm. Weakening dollar, accommodative Fed, Chinese supply restrictions, and prices already in breakout mode above $100. January 29th morning, silver hit $121.64. Have you ever seen what happens when an asset goes parabolic? Let me show you the madness through actual numbers. The iShares Silver Trust, ticker SLV, recorded its largest single-day inflow in history on January 26th and 27th, pulling in $171 million. That is nearly double the previous record of $93 million during the Reddit squeeze in 2021. Trading volume for SLV hit $40 billion, dwarfing even Nvidia's $23 billion that same day. Citigroup published research projecting $150 silver within 3 months. Social media exploded with screenshots showing six-figure gains. People who'd bought at $80 were up 50% in a week. People who'd bought at $90 were up 35% in days. The euphoria wasn't just retail traders in their basements. Institutional research was feeding the frenzy. The momentum was undeniable. And that's exactly when the professionals knew it was time to pull the rug. 7 o'clock Eastern Time, January 30th. You're probably thinking that's when silver started falling, right? Actually, that's when the massacre was announced. President Trump nominated Kevin Warsh as his choice for Federal Reserve Chair. Markets perceived Warsh as hawkish, someone who'd prioritized dollar strength over accommodation. The dollar immediately reversed higher, but that wasn't the only domino falling. The night before, January 29th, after hours, Microsoft reported earnings. Their stock crashed 10 to 11% on slowing Azure growth projections. Why does a tech stock matter to silver? Because in modern markets, everything is connected through leverage. The hedge funds and proprietary trading desks that were long silver had financed those positions by shorting tech stocks or using tech as collateral. When Microsoft collapsed, it triggered margin calls across portfolios. Traders had to sell their winners to cover their losers. Silver was the biggest winner. You can see where this is going. Then CME Group, the exchange that runs our silver futures market, announced an 18% increase in margin requirements, effective immediately for the January 30th session. Traders who wanted to hold their positions now had to post an additional $10,000 to $15,000 per standard 5,000-ounce contract. Think about the timing. Dollar strengthening, tech collapsing, margins hiking, all within 12 hours. This wasn't coincidence. This was coordination. Spot silver plunged 28% to $83.45 intraday. Silver futures crashed 31.4% to settle at $78.53. Let me put that in perspective. This marked the worst single-day decline since March 1980, when the Hunt brothers' attempted silver corner collapsed under regulatory pressure. Some of you remember that. Most of you have only read about it. Well, you just experienced the modern version live. The destruction wasn't just on our exchanges. In Rajkot, India, 44 silver trading firms declared insolvency with liabilities near 3,500 crore rupees, approximately $425 million. These weren't small retail traders. These were established firms that had been caught short during the rally, forced to cover at $120, and then watched in horror as prices collapsed below 80. They couldn't cover, they went bankrupt overnight. Here's what you need to understand about January 30th. Every single person who bought silver above $100, thinking they were early to the $150 target, lost at least 22% in a single day. People who used even modest leverage, say 5 to 1, got completely wiped out. The margin increase alone would have forced liquidation, but combined with the price crash, it was a death sentence for leveraged positions. You survived January. You watched silver go from fundamentally driven in the first 3 weeks to euphoric in days 21 through 29 to catastrophic on day 30. The question isn't whether it was brutal. The question is whether you learned what the market just taught you, because February is going to test whether you were paying attention. The professionals saw January 30th coming. The data showed it building. And now those same professionals are looking at February with a very different message than what you're hearing on financial television. Before you click buy on that dip, you need to see what the forensics actually reveal. Here's what Wall Street doesn't want you to understand about January 30th. They're calling it a normal correction, a healthy pullback after excessive speculation. They're telling you the fundamentals haven't changed, that silver just got ahead of itself. But when you actually examine the data, when you look at what's happening in the physical market versus the paper market, you see something completely different. You see a system that's breaking down in real time. Let me show you 3 pieces of evidence that prove this wasn't just a correction. This was a coordinated flush to protect institutions that were dangerously exposed to physical delivery demands they couldn't meet. Start with the COMEX warehouses. According to market data aggregators tracking exchange inventories, registered silver, the metal that's actually available for delivery against futures contracts, has declined approximately 70% since 2020. Think about what that means. The exchange, where America's silver price is set, where billions of dollars in contracts trade daily, has 70% less deliverable metal than it did 4 years ago. And this isn't some conspiracy theory from internet forums. This is publicly reported data from the exchange itself. The Silver Institute, the industry's own research organization, reports something even more concerning. The global silver market has been in supply deficit for 5 consecutive years. We're not talking about small shortfalls. The cumulative deficit from 2021 through 2025 totals approximately 820 million ounces. That's nearly a full year of global mine production just gone, pulled from above ground inventories to meet demand that mining couldn't satisfy. And their projection for 2026, another 200 million ounce deficit. But here's where it gets really interesting. In January 2026, something unprecedented happened in the delivery dynamics. Delivery notices for the January contract reached 48.8 million ounces, 4.1 times higher than January 2025. You might think that's just increased demand, right? People wanting to take delivery of their silver. Except there's a detail that should make you pause. Traders were doing something called backward rolling, moving from March contracts back to January and February for immediate delivery rather than waiting. Think about that logically. Futures contracts are typically cheaper the further out you go in time, because you avoid storage costs and immediate capital commitment. So why would sophisticated traders pay more to get silver now instead of waiting 2 months? There's only one reason. They needed physical metal urgently, not financial exposure. They weren't speculating on price, they were scrambling for actual silver. And then there's the physical paper disconnect that emerged globally on January 1st, the day China implemented export restrictions. In Japan and the United Arab Emirates, physical bullion dealers who actually had silver bars to sell were charging approximately $130 per ounce. At the same time, COMEX futures showed $72. Let me repeat that. Physical silver was trading at an 80% premium to paper contracts. An 80% premium has never occurred before in modern precious metals markets. Not in 2011, not in 2020, not ever. What does that tell you? It tells you the paper price and the physical reality completely separated. The futures market said silver was worth $72. People with actual metal in their hands said it's worth $130. One of those prices is real. The other is a fiction maintained by a system that can't deliver what it's promising. Now let's talk about the margin hikes, because this is where the coordination becomes visible. CME Group, the company that runs our futures exchanges, executed 3 margin increases in January using something called Rule 802 authority. This rule allows them to change margin requirements at any time without notice for risk management purposes. Sounds reasonable, right? Exchanges need to protect themselves from defaults. Here's the timeline. First hike on January 7th raised silver maintenance margins to $32,500, a 47% increase. Second hike on January 29th added another 18%. Third hike announced for February 2nd, adding another 36%. Each increase forced traders to post tens of thousands of additional dollars per contract, or liquidate their positions. And remember the timing. These weren't gradual adjustments over months. These were rapid-fire changes during the most volatile period in 45 years. Does this pattern sound familiar to anyone who knows their financial history? It should. It's identical to how regulators broke the Hunt brothers' attempted silver corner in 1980. They raised margins repeatedly, forcing liquidation until the position collapsed. The only difference is that in 1980, the government admitted they were targeting specific traders. In 2026, they're calling it risk management. But here's what should really concern you about CME Group. They're not a government regulator. They're a for-profit corporation, ticker symbol CME on the NASDAQ, with a market cap in the tens of billions. And who are their clearing members, the firms that would face default risk if silver prices kept rising and contracts had to be delivered? The major bullion banks, the same institutions that have enormous short positions in precious metals. So, when CME raises margins to protect against defaults, who exactly are they protecting? During Friday, January 30th, when the crash happened, the leverage unwind was catastrophic. ProShares Ultra Silver, ticker AGQ, which uses 2-to-1 leverage, crashed nearly 60% in a single session. The iShares Silver Trust, SLV, which doesn't use leverage at all, fell 29%. Both funds suffered their worst days on record. People who thought they were making conservative investments in silver ETFs watched 30 to 60% of their capital vanish in hours. And the margin increases weren't finished. The new percentage-based system CME implemented in January 2026 hiked maintenance margins to 15% for standard positions and up to 16.5% for heightened risk profiles. They effectively ended the era of cheap paper speculation that allowed traders to control 5,000-ounce contracts with minimal collateral. Some are calling it a margin trap designed to prevent a clearinghouse collapse, as prices surge toward $120 per ounce. Think about the mechanics. You're a trader who bought silver futures at $90. Price rallies to $120. You're up 30%. Life is good. Then CME announces you need to post 50% more margin by tomorrow morning. You scramble to find the cash. Then price drops 10% in a day. Now they announce another margin hike. You don't have unlimited capital. You're forced to sell. And when you sell, you push the price lower, which triggers more margin calls for other traders, which causes more selling. It's a death spiral, and it was entirely predictable. Now let's look at what industrial users are doing, because their behavior tells you everything you need to know about whether the shortage is real. In October 2025, Samsung C&T, the trading arm of Samsung Group, finalized a mining prepayment deal providing $7 million to Silver Storm Mining to restart the La Parrilla mine in Mexico. Standard deal, right? Mining company needs capital, industrial user provides financing, except there's a clause in the agreement that's anything but standard. Samsung obtains exclusive right to purchase 100% of the mine in silver-lead concentrate output for the next 2 years. Not a percentage, not first refusal. 100% exclusivity. Samsung is vertically integrating, bypassing exchanges entirely, locking up mine output before it ever reaches the market. Why would a technology company do that, unless they no longer trust paper markets to deliver physical supply when they need it? This isn't isolated. Silver lease rates, the cost of borrowing physical silver, spiked 40% in October 2025 and remained at approximately 8% in early 2026. For context, normal lease rates run 1 to 2%. 8% lease rates indicate severe physical tightness. Someone desperately needs to borrow silver, and the people who have it are demanding massive premiums because they know how scarce it is. There's also an unconfirmed report that on December 26, 2025, the Federal Reserve Bank of New York delivered a $17 billion emergency cash injection to an unnamed bank. I can't verify this officially, but it's been cited in multiple market analyses. If true, it suggests a major institution faced a liquidity crisis right as silver was beginning its parabolic move. Was it related to precious metals exposure? We don't know, but the timing is suspicious. And then there's JP Morgan, the name that keeps appearing whenever silver manipulation gets discussed. Here's what we know for certain. In September 2020, JP Morgan paid $920.2 million, the largest CFTC penalty ever assessed, for precious metals manipulation via spoofing during 2008 through 2016. This wasn't a settlement where they denied wrongdoing. Two of their traders, Michael Nowak and Greg Smith, were sentenced to federal prison in August 2023. Nowak got 1 year plus a $35,000 fine. Smith got 2 years plus $50,000. These are documented facts, not speculation. Recent market reports claim JP Morgan closed 200 million ounces in paper short positions and accumulated 750 million ounces physical between June and October 2025. I need to be clear. The CFTC does not publish individual bank positions, so these numbers are speculation. But what is confirmed in January 2026 COMEX delivery reports is that major banks showed significantly elevated physical delivery activity during the rally period. Think about what that pattern would mean if it's accurate. A bank with a massive paper short position that's been caught and fined for manipulation before suddenly starts taking physical delivery and closing shorts right before the biggest squeeze in 40 years. Either that's the most fortunate timing in financial history, or someone knew exactly what was coming and positioned accordingly. Here's the bottom line on the forensics. The physical shortage is real, documented in declining COMEX inventories, and 5 straight years of supply deficits. The margin hikes were coordinated, executed with perfect timing to flush leveraged longs at the peak. And industrial users are bypassing exchanges through vertical integration because they don't trust the paper system to deliver physical metal. These aren't theories. These are facts derived from public data, industry reports, and documented regulatory actions. So when financial media tells you January 30th was just a healthy correction, ask yourself, healthy for whom? Not for the retail traders who got margin called into bankruptcy. Not for the Indian firms that went insolvent. Healthy for the institutions that were short and facing delivery demands they couldn't meet. That's who benefited from the crash, and that's who's setting up the same trap for February. Now that you understand what really happened in January, let's talk about February, because history is about to repeat itself in a way that most people won't see coming. While everyone's debating whether to buy the dip, professional traders who call the January 30th crash are sending a very different message. And if you ignore what they're saying, you're going to become exit liquidity for the second time in 30 days. Let me show you something that should immediately change how you think about buying silver in February. Analysis of silver's seasonal performance reveals a pattern so consistent it's almost mechanical. Over the past 10 years, short positions have been profitable in 80% of Februaries. That's 8 out of 10 years where silver declined during this specific month. If you narrow it to the most recent 7 years, the success rate climbs to 86%. Silver declined in 7 of the 8 Februaries from 2018 through 2025. But it gets more specific. The window from February 20th through April 25th has seen silver decline in 35 of the last 46 years. That's a 76% frequency over nearly half a century. Even during the massive 2002 to 2011 bull market, when silver went from $4 to $50, it only traded higher during this period 4 times, according to analysis by Jeff Clark. 4 times in a decade-long bull market. That's how powerful this seasonal weakness is. Think about what you just survived in January. A parabolic rally followed by a catastrophic crash. Technical indicators are now flashing warnings that most retail traders aren't trained to recognize. The January monthly candle closed as what technicians call a shooting star pattern. That's a long upper wick representing rejection at higher levels, a small body near the open, and it's a classic reversal signal after parabolic rallies. Translation: the market tried to go higher, got violently rejected, and closed near where it started. That's not bullish. Here's another data point that should concern you. Silver traded more than 100% above its 200-day moving average at the peak. That's a level of overextension that exceeded even the April 2011 bubble, when silver hit $50 before collapsing to $26 in days. When assets get this far above their moving averages, they don't gently drift back down. They crash, consolidate, and then decide whether the bull trend continues or dies. Mark your calendar for these key February dates because each one represents potential volatility. February the 2nd, Owanda Japan's new 5-to-1 maximum leverage limits take effect, forcing Japanese retail traders who've been piling into silver to reduce positions or close them entirely. February 16th through 23rd, the Shanghai Futures Exchange closes for Lunar New Year, removing Chinese demand from the market during a critical window. February 18th, the Fed releases minutes from their January 28th to 29th meeting, potentially revealing concerns about inflation or asset bubbles that could strengthen the dollar. March 17th to 18th, the next FOMC meeting occurs, the earliest opportunity for any policy adjustment. Each of these events can trigger volatility, and volatility, when you're already down and trying to recover, is how accounts get destroyed. You don't get stopped out at your preferred exit. You get stopped out 20% lower in a flash crash because liquidity disappeared. Now let's talk about March delivery, because this is where the next potential crisis emerges. The March 2026 COMEX silver contract first notice day occurs February 27th, with the delivery period running through March. While exact open interest to registered inventory ratios fluctuate daily, the market structure shows that paper contract claims significantly exceed physical metal available for delivery in COMEX vaults. If delivery demand exceeds what the warehouse can supply, we could see another explosive move. But here's the question. Do you want to be holding leveraged positions going into that potential chaos after what just happened? There's a historical parallel worth considering. In December 2020, when the gold-silver ratio compressed from elevated levels, silver futures subsequently rallied 21.8% over the following months as mean reversion occurred. The ratio measures how many ounces of silver it takes to buy 1 ounce of gold. When it's high, silver is historically cheap relative to gold. When it compresses, silver is catching up. We saw significant compression in January as silver outperformed. If history repeats, there could be another leg higher once the seasonal weakness passes and March delivery dynamics unfold. But, and this is critical, current mine supply constraints mean 2026, as high prices will not translate to increased production until 2033 through 2036. Why? Because it takes 7 to 10 years to develop new mines from discovery to production. You can't just flip a switch when prices rise. The silver that miners will produce in 2026 reflects decisions made in 2016 to 2019 when prices were $17 to $20. And recycling contribution remains limited at approximately 180 to 190 million ounces annually, about 20% of supply. Recovery costs often exceed value for small quantities used in solar panels and electronics, so industrial users don't bother recycling. This creates a structural problem. Demand is growing from solar, electric vehicles, and artificial intelligence infrastructure. Supply can't respond for years. Inventories are declining, and the only mechanism the system has to balance supply and demand in the short term is price. Very high prices to destroy demand, or very low prices to stimulate it. We just experienced the high price phase. Now we're entering the engineered low price phase designed to shake out weak hands before the next leg higher. Let's talk about your actual action plan for February, because everything I have told you is useless unless you know specifically what to watch and how to respond. Here are your critical support levels. The $80 to $85 zone represents former resistance becoming support, and it was tested on January 30th and 31st. If silver holds above 85, it suggests strong buying interest and the potential for a bounce. The 75 to 78 level represents the 50% Fibonacci retracement of the January rally. Professional traders watch Fibonacci levels religiously because they often act as magnets for price. Loss of this level would signal a deeper correction is underway. The 70 to 72 area marks the January opening range, where silver started the month before the explosive rally. If we fall back to the beginning, it would erase the entire monthly gain and likely trigger another wave of panic selling as people who held through the crash finally capitulate. On the resistance side, $95 to $100 represents psychological round numbers in the battleground where bulls and bears will fight. Reclaiming 100 would restore bullish momentum and potentially trigger FOMO buying again. 110 to 115 was the prior consolidation zone before the final parabolic move. Getting back above this level would suggest the correction is complete and the trend is resuming. Here's what the professionals who accurately predicted January 30th are saying now. Peter Brandt, a 50-year commodities trading veteran who posted warnings about the crash days before it happened, stated publicly that he expects a short-term bounce followed by additional washout to thoroughly wash out hot-shot bulls before a durable rally begins later in 2026 or early 2027. His exact words on X: "I do believe there is more ahead for silver, but not until the hot-shot know-it-all bulls are thoroughly washed out." Marko Kolanovic, former JP Morgan strategist and institutional investor, Hall of Fame inductee, has echoed similar sentiments. Both analysts flipped temporarily bullish for a tactical bounce after the crash, but their medium-term view remains that one more flush is coming. These aren't perma-bears who always predict doom. These are traders with decades of experience who successfully called the top and are now warning about the next trap. Here's your practical approach for February that balances opportunity with risk management. Dollar cost average physical silver purchases, coins and bars, during February weakness rather than trying to time the exact bottom. Physical silver eliminates counterparty risk, can't be margin called, and you own it outright. Avoid leveraged silver futures, which proved catastrophic on January 30th. The margin trap killed everyone on 50-to-1 leverage, and it will kill you again if you don't learn the lesson. Avoid paper silver ETFs showing extreme leverage risk. AGQ demonstrated what happens when leverage meets volatility. Even unleveraged SLV can experience tracking errors and liquidity issues during crashes. Recognize that February is historically for accumulation during seasonal weakness, not speculation on quick recovery to $150. The seasonal data spanning decades tells you that trying to catch falling knives in February usually results in buying too early and watching your position deteriorate further. Wait for confirmation that the seasonal weakness has ended before deploying significant capital. Here's the perspective that should guide your decisions. Despite the brutal January 30th crash, silver still closed January with approximately 19% monthly gain. That's the 9th consecutive monthly gain, suggesting the secular bull trend remains intact underneath the violent volatility. The fundamentals that drove silver from $30 to $120 haven't disappeared. Supply deficits continue. Industrial demand grows. Central banks accumulate. China restricts exports. These forces don't vanish because of one massacre. But secular bull markets don't go straight up. They experience violent corrections that flush out weak hands and overleveraged speculators. The professionals who trade these markets for a living know this. They're not panicking. They're waiting for the washout to complete, for the seasonal weakness to pass, and for March delivery dynamics to potentially create the next opportunity. And they're avoiding the mistake that destroyed accounts in January, using leverage during extreme volatility. On January 29th, at $121, what did you do? Type in comments. I sold equals you took profits. I held equals you wrote it down. I bought more equals you added at the top. No judgment, only lessons. Because 80% of people will make the same mistake in February that they made in January. The margin trap killed everyone on 50-to-1 leverage. February's seasonal weakness will test everyone who survived. Wait for 75 to 78. Buy physical only. Let March delivery dynamics play out. And remember, the professionals who called the January 30th crash are now saying one more flush is coming before the real move. Don't be exit liquidity twice.